In this spreadsheet, we're going to talk about how you calculate the betas of portfolios and the returns of portfolios. So this is a portfolio that we either already own, and we're trying to understand a little bit about its performance, or it's a portfolio that we want to try to create, and we're looking to predict what its performance might be. So let's start off basically with our portfolio. We've invested, we're going to use in this case just 4 assets. And you can do this one of 2 ways. If you look in this cell here, you can see that it says investment, but you can either put dollars or weights. So in this case, let's go ahead and put dollars. So I'm going to put $15,000 I have invested in A, and then I have $20,000 invested in B. I have $45,000 invested in C, and I have $75,000 invested in D. And as you can see, as you plug in the dollar amounts, the weights change. Now, if you would have put in here the weights, 9.7%, 12.9, 29, etc., these weights would have been the same. So now let's look at returns. So let's see how have these things actually been returning. And again, I'm obviously making these numbers up. So let's say this is 7, this is 9.5, this is 12, and this is 15. What about the betas? If you remember what beta means, beta measures the market risk of the security. So how does this asset react when things in the stock market change? So lower numbers represent lower risk. And of course, if you remember the risk-return trade-off, lower risk implies lower returns. So let's say the beta, the first one's 0.35, next one's 0.95, 1.35, and the fourth one is 1.95. So now we have our data as input. We know what the investments are, we know what the returns are, and we have input the betas. So now we just need to look at solutions. If you were to purchase this portfolio, or if you owned this portfolio, you would have earned 12.548% or 12.55% on this investment. This investment has a portfolio beta of 1.49. So again, remembering a little bit about beta, anything greater than 1 implies a greater than average risk. So how can we use these numbers? Well, over here, the security market line is derived from the capital asset pricing model formula, and we want to plug in some numbers. So currently, the risk-free rate on a 30-year Treasury bond is about 2.9%. Let's use the average rate of return on the stock market. Let's call that 11%. And then we need to plug in here our portfolio beta. Well, in this case, it's up here, 1.492. 1.492. So the return that we would expect to get on this portfolio, based on the theory of the capital asset pricing model, is we should expect to get 14.99%. But we only got 12.54%. So now we can say that this portfolio either has underperformed or will not perform as we would like it to perform moving forward. So again, the idea here is just what has happened to us? What rate of return should I get based on theory? Now, of course, one of the assumptions is that the theory is right. The theory does have some holes. We're pretty close. We're only about 2% away, so it's not that far away. But over a long period of time, 2% can tally to quite a difference in wealth. Another thing that we can do is we can look at, well, what will happen to the stock, what will happen to this portfolio if the stock market changes? So if we plug in the beta of this portfolio, now we can say, well, what if the stock market goes down by 1%? -1. We would expect then that the market itself, the portfolio would lose -1.492%. So it's going to move up and down based on the portfolio. So what if we expected, -5, a big drop in the stock market? We're going to expect a bigger drop in the return of this portfolio because it's greater than the risk of the portfolio. What if we thought that it was going to go up by 3%? The stock market goes up by 3%, but this portfolio should go up by almost 4.5%. So you can see here, we can calculate the betas and returns of portfolios, and we can do some very basic analysis of what happens when the stock market changes, what happens when something happens in the marketplace. What happens if, for instance, the Federal Reserve decides that they're going to increase the Fed funds rate by 1%. Now that's way more than they ever would, but if they increased it by 1%, then the risk-free rate would go to 3.9%. If the risk-free goes to 3.9%, now I'm going to require an even higher required return, because now it's up to 14.5% almost. So again, we can adjust the numbers and try to see what happens when things change within the economy, change within the stock market, obviously. Another question might be, though, is, if I wanted to get a higher return, what should I do? I've invested $155,000. What should I do? Well, maybe I want to take some of this low risk asset that's giving me a low return and obviously change that $10,000, change it and put that up here. And change that up here to the higher risk one. You can see that obviously the portfolio return goes up, and also so does the portfolio beta goes up. What happens if you expect that the stock market is going to decline? Well, if I think the stock market's going to fall, I want to unload or get rid of some of this high risk stuff. So maybe I want to go down to 40,000 here. Whoops. 40,000 here. I'm going to go down to 20,000 here, right? So then up here, I need to maybe move all the rest down to here. So I need what? I need 65,000 there. I need 75,000 there, right? So now I'm obviously going to get a much lower beta. So if the stock market does fall, my portfolio is not going to fall by as far. So put it down here, 0.969. What happens if the stock market drops by 5%? The stock market goes down by 5, but I'm only going to lose 4.8. So again, we can play with the numbers and see what happens to the portfolio.